I've generally found that the idea of the long-term debt cycle is, the kind of the closest thing I have to like a master framework for what's going on right now. And it's one of those things where obviously every cycle is going to be different. It goes back to that quote that is, I don't know if it's correctly or incorrectly attributed to Mark Twain, but it's like, history doesn't repeat, but it does rhyme, right? So when, we went into this period and people keep talking about these, extraordinary events happening, unprecedented, never seen these types of things before. And just by happenstance, I had been researching this topic for years, and just kind of, it's one of those things you never know exactly why you come across the right sources. But I came across this type of research, and so this actually, in my view, prepared me for what we went through over the past 2 years, because we did have an historical analog for it. We did have some bottlenecks, and so basically what this shows is that we go through the normal business cycle, and most people just think in terms of those 5 to 10 year increments. But what we see through history is that, for reasons related to demographics and politics and, distributions of power between capital and labor and all sorts of reasons, we go through these long-term debt cycles as well. And so basically this chart shows, 100 years of history in terms of fiscal policy and monetary policy in the United States. And so we can break it apart into, the chart on the left there shows private debt as a percentage of GDP. There's technically a little bit of state debt in there too, but essentially it's all the debt sources of entities that cannot print their own money. And then you have federal debt in blue. And we see the history of kind of debt accumulation over time. And then on the right-hand chart, you have short-term interest rates, you have monetary base as a percentage of GDP, and you have fiscal deficits in gray lines as a percentage of GDP. And, it doesn't tell you everything, and there are differences between the 1940s and the 2020s, obviously, right? So there's technology differences, there's demographic differences. Back then we were a creditor nation, now we're a debtor nation, structural trade deficit nation. But there's a lot of similarities. And so basically what they did last time was they had so much debt in the system, they had so much fiscal spending, and so when they did that massive fiscal spending and it was inflationary, they were still pretty much forced to hold interest rates low anyway. And so that was kind of different from the 70s. And basically it's just the way that I'm kind of thinking about this environment and then using that as a framework so that, this is kind of my baseline. And then I look to see what is different. So what are the differences from that period? What is happening in this time? What are the specifics? And go from there. But I really find that this helps contextualize where we're at. If we were to go back in history before Bitcoin existed, gold would be the go-to for this. It's kind of an alternative currency. It's got, if you look at history, it's got anywhere between a 1 to 2% annual growth rate in terms of estimated supply growth per year. It's extremely stable. It's very, very hard to produce more gold quickly, even when the gold price spikes. And so you have this very stable kind of hard money currency. And, there's not a lot of demand for that in an environment of stable monetary policy where you have positive real yields, because there's an opportunity cost for holding this zero yielding asset. But when you're in an environment of inflation, and then specifically inflation that's higher than the interest rates, then suddenly, a zero yielding asset looks a lot better than a negative yielding asset that they're printing a lot more of. And so that's why, for example, if we look at the 80s, inflation was still high, but gold did poorly because by that point, yields were above inflation. And so there was a case, Volcker had addressed the negative yield concern. And so, after gold had that bubble, a lot of capital wanted to get back into treasuries because you actually had a positive real return now. And so gold has been a great, protection against, the devaluation of currency and bonds. But of course, now with the invention of Bitcoin, we have this other asset that we can explore, and that is, taken arguably market share and also just thought share and basically mind share from gold. And so we have this, again, we have a scarce, money that doesn't, we know it's supply issuance. We know that it has this hard cap. It's for the most part globally accessible. And this is, this kind of sovereign debt problem is mostly a global phenomenon, at least among developed countries. But of course, you also see inflationary events even more thoroughly in emerging markets for mostly separate reasons. And so there's naturally a demand for this, especially in an environment where we're going to have probably persistently negative real yields for quite some time. And the caveat of say you look over the past 12 years or say 10 years of Bitcoin's price history, And it's not necessarily like this one-to-one and say inflation hedge, because it's, for most of that time, it's this very small, volatile, kind of crazy asset. And so it's kind of like how if you look at, say, a growth stock in the early days, it tends to not be super correlated with anything in some cases, because it's kind of on its own cycle. It doesn't really care about recessions, for example, because it's growing at like 40% a year and it's eating its competitors.
Before we continue, help us clicking that YouTube like button and subscribe now to our channel. This shows the algorithm that you valued this information, and it helps us spread that message. Sharing is caring. And now, let's continue.
And so it's going to grow regardless of what the economy is doing. But of course, once it gets big enough and it becomes the sector, then it becomes more susceptible to those cycles. And so Bitcoin in the first decade or so is this emerging asset class from zero, and so it doesn't fulfill its inflation hedge or store of, it's like an emergent store of value is how I describe it. It's this asset that the market is kind of testing and getting to know, and it's exploring its total addressable market cap, and it's kind of coming into its own as a store of value, inflation hedge type asset. So a lot of those kind of historical comparisons for it, or as much as you can call 1 decade historical, are not going to show this precise defense against inflation or financial chaos like we saw in March 2020 when Bitcoin fell along with everything else. But I think the whole thesis is, if you understand it and if you come to understanding you think it's going to be successful, then I think in the long run, looking over the 2020s, it is likely to do very well compared to negative real yielding bonds. Kind of like how most hard assets should do pretty good in that environment. But then if you look at Bitcoin's qualities and for whatever reason you come to the conclusion that it's probably going to take market share from other things and become a bigger share than it currently is of global assets, then it would probably be one of the better ones, if not the best. The whole Lindy effect, right? So the longer it goes, the more credible the next prediction becomes, right? So Bitcoin at 60,000 was some people would dismiss that 2 years ago, but here we are, right? So then when you're at 60,000, 200,000 sounds less crazy than when you were at 4,000, right? So as it kind of takes market share, and then you can assess the information at the time, and then constantly update your model for how big Bitcoin could become. And so I generally start with conservative, kind of total addressable market, but then as it meets certain frameworks, it becomes easier to expand your base case for how big it could get, as long as you start with the idea that actually you can have some upper bounds for how big it can get. And so that's the approach I've been doing. And then two, I would point out that I think one of the problems especially the past 10 years, kind of the post GFC environment, a little over 10 years, is that for lack of good money, people are clearly monetizing other things, right? So in the U.S. we have the highest equity valuations as a percentage of household assets we've ever had, and it goes back to the whole there is no alternative, TINA, right? So they're like, well, I can't hold cash and bonds, and so I got to buy equities, even though I'm looking at, say, the CAPE ratio or the market cap to GDP ratio or whatever your preferred valuation metric is, and you're saying, well, I know they're expensive, but I have to hold them anyway. And so in many cases, we've essentially monetized the S&P 500 as a store of value rather than thinking of it as an investment. It's like we got to just shove money in there that we don't know what else to do with, because we can't just leave it in T-bills. And so the same thing's true for prime real estate. So if you're a billionaire and you're trying to figure out how to preserve your wealth, you're like, well, I mean, I don't know how to value this beachfront property. It seems expensive. It doubled over the past 2 years, but I'd still rather own this than T-bills. And so the argument among some of the really bullish Bitcoiners is that if you do continue to reach certain thresholds and Bitcoin just keeps going, it becomes, if you have this kind of global hard money, it becomes an alternative that people have monetized these other assets. They've essentially added a monetary premium that is above their utility value. And so we're, in that world, let's say Bitcoin gets big enough, it becomes worth, tens of trillions of dollars, which is still small compared to, say, global money supply or global asset value. But if it starts to reach those types of market caps, you could argue that things like certain types of real estate, certain types of stocks, fine art, that things that people have put an additional monetary premium in for lack of good money might get drawn out and into Bitcoin, and that those things return to a more healthy valuation where they're mostly held for their utility value, and that they have more reasonable valuations. Therefore, they have higher returns for taking on risk. Whereas, Bitcoin becomes like the conservative gold-like hard money asset. But that's, of course, right now we're still at roughly $1 trillion market cap, so we're still kind of premature to that type of assessment. But that would be the argument for people that have a very optimistic look into Bitcoin's maybe 20-year future.
Do you want to know one thing about crypto? I made over 3,000% in profit in a few weeks. Fact is, the traditional financial system, the traditional money system makes you poor, not rich. If you want to earn $500,000, $1 million, you have to wait until you're 50, 60, 70 in the traditional financial system, and you probably will still be broke. And you will be old. This is not a sexy combination, as you can imagine. But the question is, how can you start in crypto and make these profits? Where to invest? Where to start? My name is Gunnar and I'm from Germany, as you can hear, and things are a little bit different in Germany. More about that later on. Fact is, there are lots of different cryptocurrencies. It's a gigantic universe where beginners and professionals get easily lost. But there is light at the end of the tunnel. There are 7 key steps you need to follow to become successful in this market. You have to know them, and if you fail one of them, it's literally impossible to succeed in this market. Just an example, one of the key points is your exchange, and one of the biggest are, for example, Binance and Coinbase. These are trusted and well-established exchanges, but, and this is a big but, you won't find the super profitable coins on those exchanges. The unknown super profitable coins that get gigantic profits are not traded on those kind of exchanges. They are traded on much smaller insider platforms that are barely known. And I can tell you what those super secret exchanges are and why they are so profitable. And another super important thing are the right information sources. The point is, the internet is gigantic. There are hundreds and hundreds of YouTube channels, blogs, pages, and much more. And there are also market makers and influencers. For example, Elon Musk, he is not a crypto guy, but the moment he recommended Dogecoin, it went through the roof, to the moon, so to say. But why did he recommend it? Where did he hear it from? He didn't hear it from newspapers. And believe me, he is listening to someone. But you have to know who, and you have to react before he is reacting. This is really important. And these are only 2 of the 7 steps you have to follow in order to be successful in crypto. And if you want to know all of these steps in much more detail, and if you want to have a comprehensive checklist, here's what you should do. There is a link below this video. Click on this link and you will get the opportunity to subscribe to my channel. Click on the link and you will see a video where I explain the next steps. So see you soon. Click on the link now. I'll see you there.